The Future Homeowner Show.
Hello and welcome to the Future Homeowner Show. I'm your host, Eric Helon, and I am excited about what we're going to talk about today because I think it's so necessary for those who are looking to buy their first home in today's market to understand not only what's going on in the market, but to understand the concepts that will help you buy, save you money, and get you into your first home faster. So let's dive right in with our pulse of the market.
Pulse of the market, what's moving out? Pulse of the market, we'll show you how. Rates in the money, inventory low, hot homes get picked before they even show. Neighborhood numbers count every trend. We wreck the signs and explain the end.
The first article I want to talk about in the pulse of the market is this article that I found on Realtor.com, which is kind of some sombering news for those who are looking to buy their first home, especially millennials who want to get into home ownership and want to be more set when it comes to retirement. And this title really caught my eye because it says the typical home will cost more than $1 million as millennials hit retirement. And so what the economists were saying is that over the next 25 years, they expect the average home to cost more than $1 million. And to put that into perspective, the article talks about where home prices were in the 1990s. So the national median home price in 1990 had homes priced at only $90,000. And even in high priced areas like San Francisco, the median price was only $250,000. So what this is telling me is that homes are expected to continue to rise at an accelerated pace. That's still to be expected. And unfortunately, there's going to be a lot of folks who are nearing retirement or entering retirement in the next 25 years that are going to find it hard to, really take advantage of home ownership. Now, of course, the goal is that you would already be in a home, maybe your first home, your second home, or your dream home, but that appreciation would actually be working in your favor as opposed to working against you. So if you're looking at this as trying to buy a home later in life, this could be bad news. But if you're looking at it from somebody who's looking to buy your first home as soon as possible, get into real estate, and let your home appreciate over the next 25 years, this is actually good news because economists do see that home prices are continuing to rise and they expect that to happen over the next 25 years. So if you buy a home today, chances are your home could be worth $1 million in 25 years. That is good news. So keep that in mind when you're thinking about buying now versus later, and we'll kind of touch on that as we go into our deep dive. But obviously, the sooner you can get in, the more appreciation can work in your favor. And with home prices having an average of $1 million in 25 years, that can actually be good news to you. Now, the second article that I want to talk about may not necessarily be good news. This is really going to be a struggle for a lot of folks who are looking to save money to buy their first home. And this article was saying that if you're saving for a down payment, inflation may actually be quietly erasing your progress. And so what they found is that people who are saving money in a typical savings account are losing money at a faster pace because inflation is over 4% and your bank is probably paying you 1% in a traditional savings account. So what they found were opportunities for you to try to combat inflation by investing your savings, your down payment savings, into either a high yield savings account or a CD, depending on the time frame that you have to buy your first home. So the genesis of this is saying, hey, inflation is higher than what banks are paying on savings accounts. So if you're looking to save for a down payment, especially 10 to 20%, you may actually be losing money year over year as that inflation is beating out your savings. So when you're thinking about saving money to buy your first home, look at a high yield savings account or a CD. And my advice, I know this sounds counterintuitive, but you should really be looking to put the minimal amount down to get you into a home that you can afford. What I mean by that is let's say you're trying to save 20%, it might take you 10 to 12 years to save that amount, while you can get into a home and say the next 2 years and let appreciation work in your favor, taking your, giving you some equity in your home. And so as you're trying to save over the next 10 to 12 years for that 20% down, you may actually be losing money or combating inflation, and it could take you longer than expected. So my advice, especially if you read this article on realtor.com, look at the numbers. They're saying that, you could be saving over 11 years to try to save for a down payment. Think about where home prices are going to go based on that last article that we just talked about. And think about how inflation is going to be erasing that savings for you and making you save for longer to save the same amount of money. So keep that in mind as you read these articles on realtor.com. Think about how they'll impact your home buying journey, and how you can get into your first home as soon as possible so that these things can work in your favor. That's all I wanted to cover today for our pulse of the market. Let's take a second to jump into our deep dive.
Deep dive, yeah, go a little deeper. Deep dive, get wilder. Deep dive, deep dive, deep dive, deep dive, deep dive, deep dive, deep dive.
So on today's deep dive, I want to talk about the hidden costs of waiting to buy a home. I often get asked the question, should I buy now? Should I rent? When's the right time? When's the perfect market? And to be honest, the perfect time and the perfect market is when you can get qualified to buy. And I say that because your qualification is not guaranteed. There are a lot of economic factors that come into that pre-approval that you'll get from a lender. And that can be based on your job, your income, your credit, the overall economy. So there's really no guarantees that you can even get qualified next year. So if you talk to a lender and you get qualified right now, you need to take advantage of that opportunity. And so when you're trying to time the perfect market, you oftentimes will price yourself out of the market because, as I mentioned in our pulse of the market, economists are seeing home prices go up. And with home prices going up and inflation up and interest rates up, you're really kind of swimming upstream. And so getting qualified as soon as possible is vital, and taking advantage of that pre-approval as soon as possible is even more important in today's market. So obviously we talk about perfect market. There's no such thing as the perfect market. The perfect time is when you can get approved for a home that you can actually afford in your budget. That's the perfect time for you to buy a home. When it comes to down payments, we often are asked, well, should I save that 20% down or 10%? As I mentioned before, you want to save the minimal amount needed for you to qualify. So if I only need to save 3% and my lender says that they can qualify me and that mortgage amount is the amount that I can afford on a monthly basis, then I should only put down that 3%. Why put down 10 to 20%? Why utilize your capital to buy into a home when you can actually set that money aside, keep it, invest it even better, and let it build on itself as opposed to putting it into your home. The home prices are only expected to go up between 3 to 4% every year over the next few years. That's what economists are saying. When you could take that savings amount and put that into, the stock market, whatever the case may be, and be earning 8 to 10% on your money as opposed to just 3 or 4% putting it into our home. The other thing is that gives you some type of protection. You have a safety net there. So if anything were to come up and you need money for emergencies, it's a lot easier to liquidate, a stock market investment than it is to liquidate a home that you live in. So keep that in mind when it comes to down payments. The other thing, that we talk about on an ongoing basis is the fact that rents continue to go up. So as you're waiting for the perfect market, unfortunately, your rent is going up every year. And so typically what we're seeing right now is that rents are going up about 4%. Some are seeing 5%. Some areas do have rent caps and things of that nature. But when your rent is going up every month, it's now competing against inflation. and it's competing against the cost of living raise that you may get at work. So let's say you get, maybe a 2% raise at work, but your rent goes up 4%. Well, you're at a net loss of 2%. And so you have to think about your dollars and the amount of money that your dollars could be earning you. And so when it comes to waiting for the perfect market or waiting for the right time to buy, if your rent is going up every year, oftentimes you're going further and further into the red, thus prolonging that process and that wait time for you to make that transition from renting to owning. So keep that in mind as well. Now, that's kind of on the defensive side, but also we got to talk about what you're missing out on the offensive side. Because offensively, when you buy a home, your expectation is that your home is appreciating. And I know I talked about, 3 or 4%, but your rent that you're paying is not appreciating in your favor. It's appreciating in your landlord's favor, but not your favor. And so you're missing out on the growth potential of that home as well. So with rents going up, yes, you're losing, but with appreciation going up, you're kind of missing out on that value that you could be gaining as well. So keep that in mind. You're kind of losing on both sides. So the faster you can get into a home, the more you can control your costs. Not all costs are going to be flat, or the same every year. There are going to be property taxes that will see an increase as your property goes up and your appreciation shows that your home is worth more every year. And then you may see an increase in your property insurance as well. So your taxes and your insurance will likely go up every year, but not as dramatically as your rent could go up. So keep that in mind as you're looking at your fixed costs every month when you're comparing buying versus renting. I know there's a lot of information out there that says, oh, when you buy a home, you fix all your monthly fees. That's not true. There are some things that can go up. They just may not go up as dramatically as your rent would. Another thing when it comes to waiting to buy is that you're missing out on potential tax advantages. There are few tax advantages here in America that we can take advantage of. More of them are aligned to like entrepreneurship, owning your own business, writing off expenses, things of that nature. But there are also opportunities and tax advantages to owning a home where you can write off the interest that you're paying on that home. Now, not everybody gets to do that. So you need to talk to a tax advisor. I am not a tax expert, but there could be opportunities and tax advantages for you that you're missing out on because you're waiting to buy. So again, talk to the professionals in your life. You should be talking with your loan officer, your real estate agent, and a tax professional about how to get into a home and take full advantage of all the opportunities that home ownership affords you. That's really what I wanted to cover today in our deep dive. When you're thinking about buying versus selling and trying to time the market and wait for the perfect market, I can tell you this: there's no such thing as a perfect market. There is a perfect time, and that is as soon as you get approved to buy and that mortgage is in your budget. So keep that in mind when you're thinking about when is the right time to pull the trigger and buy your first home. With that in mind, let's go ahead and jump into our Q&A session. Real questions, real answers.
No more guessing, no more doubt. Real steps, real answers, that's what we're about. Real questions, real answers. Ask it plain. Real questions, real questions.
So I got an interesting question this week from somebody online who was asking about should they use their retirement funds, their 401k, to buy their first home? And my response was, it depends. There are a lot of times where you don't want to touch your retirement funds, and especially if you're getting close to retirement. And so the reason why it depends is because I need to know, how old you are, when you plan to retire, where you plan to retire, and then also what type of returns you're getting in those retirement funds. People always ask about, using those funds to buy a home, but if you're earning 8 to 10% with your retirement, it may be beneficial to leave that money there because that return on investment is going to be better than it would be in a home. And I know this is like, you wouldn't expect to hear this from somebody who specializes in real estate, But at the end of the day, your money needs to be working for you. Where can it earn you the most amount of return? And take into consideration not only return, but opportunity costs. So as we talk about like rents going up and things of that nature, you have to take that into consideration when it comes to investing your money. So if you were to take the money out of retirement to buy a home and say your rent's been going up 5% every year, well, yes, you're saving yourself that 5%, but maybe, homes in your area are only appreciating at 3%. So you're gaining that 3% appreciation. So overall, you have about an 8% return on your money. But if you look at your returns in retirement account and you're getting, say, 12% return year over year, your money is best suited there. Let's try to save money from your traditional income. Start to really look at your budget and find ways to cut back so you can save some money and utilize those funds. Take advantage of down payment assistance programs where you don't have to come in with as much of your own money, and try to take that route as opposed to pulling money out of your retirement account. So that would be my honest feedback. You really need to dive into the numbers. You need to understand when you're going to retire, where you want to retire, what type of returns you're getting with those funds, and compare them to what would happen if you took it out and put it into buying your first home. So I hope that helps some folks who are thinking about using those funds. It's great to have them available to you. But if you don't want to take money from some type of investment that's working well for you and put it into something that's earning slower percentage returns. And so just always think about that. Your rate of return really matters for every dollar that you earn. And with that, I will end this episode of the Future Homeowner Show. I am hoping that you're getting value from these episodes. I know that we're putting out our podcast on a weekly basis. We're getting some good feedback, and I just wanted to reach the masses. So if you are listening to the podcast, feel free to share it on your social media channels. Wherever you're listening to the podcast, whether it be on YouTube, social media, on your podcast platforms, just be sure to share it with someone. We want to make sure that this information is getting out there. We know there's a need. We know that people have these questions and they're trying to figure this out. We don't want them to try to figure it out on their own. We're here to help. So that's it for this week's episode. I hope to see you on the next one. And until then, be blessed.
The Future Homeowner Show. Yeah. We taught that first key glow. Let's go. Yeah. Savings on the table, dreams in the frame. First time buyer, we know your name. Credit down payment, what's in the plan? We make it clear so you understand. Take a breath, we got you. One step at a time, no pressure, just truth. Now lean in, hear the voice. Your home starts here with the right choice. The Future Homeowner Show.